China bear, the famed hedge fund manager himself, Jim Chanos, president and founder of Kynikos Associates, joins us from Singapore. And of course, Jim, still shorting China. Jim, how's your Asia trip going?
It's going well, Susan. Thank you, and thanks for hosting me.
Hey, Jim, first off, before we get into China, let's talk about what's happening in Europe, of course, because the markets are bouncing, which you said is not good for bears like you and short sellers. But you were short European banks. Is it time to wrap up those positions and maybe try to book some profits?
Well, I think that if the Europeans have solved the crisis, it's going to be a unique set of circumstances if this is it. Because, first of all, the ECB has to get involved, and they're not involved in this. Second of all, you're trying to solve the problem, as others have said, by adding more debt to the situation. So we've kicked the can down the road into 2012, apparently, but you haven't really solved the problems. And if I'm a debtor nation other than Greece, and I see that by holding out I can get a 50 cent on the dollar relief on my debts with no credit event, so to speak, for the credit default swap owners, why won't other governments hold out for this? So again, I mean, this is a Band-Aid, and at best, but it solves the immediate problem for the next handful of months.
But, whoa, take a look at these monstrous gains on the markets, Jim. I mean, everyone's reacting like everything's A-OK again in the markets. I know you're not a macro guy, but how long do you think these gains will last, and doesn't that hurt your positions?
Well, the world was coming to an end on October 4, and now every problem in the world has been solved 3 weeks later. My guess is the reality lies somewhere in between, Susan.
Okay, somewhere in between. Now, we all know, of course, famously that you're a big China bear. So do you find it ironic and maybe a little humorous that China is being counted on to save the world?
Yes, and they sent probably the worst ambassador they could have to go hat in hand asking for money. Look, the Chinese were supposed to save the Greeks directly a few months ago, if you remember. That didn't happen. They were supposed to get involved a year ago in the European crisis. That didn't happen. China will do what's in China's best interest, I'm pretty sure. And given that the Europeans apparently think that they've solved this mostly on their own, the Chinese will say nice words to them, but I doubt we'll see much hard, cold cash head to Europe from China.
Now, why do you think that? Because Japan has already bought up the first issuance of these EFSF bonds. I mean, isn't it China's interest also to diversify as well? They get something back in terms of cold, hard profits.
Well, remember, China has been buying European bonds anyway, so they buy as part of their general diversification. So they can buy Euro bonds as part of their general course of investing in as their foreign currency surpluses. But let's keep something in mind. There's a big misconception here, and I deal with it when people talk about recapping the China banks or bailing out different sectors. The foreign currency reserves that China have liabilities against them, and everybody forgets this. The foreign currency reserves arise when exporters earn income in euros or dollars and go to the People's Bank and turn those in for RMB. There are RMB, like any central bank liability, there are RMB liabilities against their dollar and euro holdings. So it's not free and clear, and people sort of always forget that.
Okay, well, let me ask you this then, because we got Chinese biggest banks. In fact, they're set for record full-year profits, and you've been shorting famously the Chinese banks, the Chinese property plays. Do you still think China's on a treadmill to hell?
Oh, I think they're on a bigger and faster treadmill than ever. This week we've had numerous reports now of people besieging property developers' offices because of price cuts. The Chinese are beginning to realize that property prices can go down as well as up, and this is going to be a very troubling development for the Chinese property market. Number two, take the Chinese reported results with a big grain of salt, Susan. I mean, first of all, Western banks reported record profits in 2007 before collapsing. It's all about credit. And in the last two banking crises in 1999 and 04, China's banks had 40% non-performing loans to total loans. And there were no recessions in those periods. This is just getting started. And I think that real estate transactions in September, October in the Tier 1, 2, and 3 cities that we track are down 40 to 60% year over year. So the property the property slowdown, or worse, has started. The question is, how is it resolved?
Okay, well, let me just get into these specific numbers. You are specifically short Agricultural Bank of China, but take a look at their latest report card. I mean, we had a 40% boost in profit, right? And their NPLs, even though you're saying that we're looking at huge NPLs, they only have 1% on their books, 1.5% to be specific.
Right. They've had 1% for a long, long time. They also are holding on to their restructuring receivables from the previous two bailouts from 1999 and 2004 at 100 cents on the dollar. And those receivables equal over 100% of their tangible book value. Those receivables were not paid off in 2009 when the asset management companies that the government set up to take bad loans had them come due. So they have still receivables on their books from the last two bailouts. As I said, at 100 cents on the dollar, those things are probably worth 10 to 20 cents on the dollar. So we take the accounting at the Chinese banks with a large grain of salt.
Okay, but then you heard from someone like Stephen Roach, of course, of Morgan Stanley, says that the Chinese economy fears of crash are overblown. He says he's not denying there are some structural issues, but you can't deny about the consumer-led transformation. It's powerful considering how much money is stacked under the mattresses of a lot of the Chinese at 1.3 billion in the population.
Well, Steve is my colleague at Yale, too, and we're both, so I'm loath to say anything about anything insightful Stephen says because he's a very smart guy. But keep in mind, most China observers weren't even talking about any landing 3 months ago, and now they're confidently talking about a soft landing. So somehow the plane was supposed to be aloft earlier this year, and now we're figuring out on how it hits the ground. That having been said, the Chinese consumer, as Stephen well knows and others do know, is a declining part of the Chinese economy. Consumer as a percent of GDP is dropping, Susan, not going up. Fixed asset investment is what's driving everything. It continues to increase. In the latest period we had, fixed asset investment was up another 24% year over year versus 9% growth in the economy.
Yeah, Jim, another point I want to highlight is that people are saying, you know, this is an engineered slowdown by the Chinese government. I mean, just a few months ago, I'd say a year ago, it was overheating. Now it's slowing down too much and it's on its way to a crash. It seems like they can't ever win or balance it out.
Well, again, I mean, they were overheating a year ago, and now they're going to engineer a soft landing. Seems to be the market gets very, very much bifurcated in its views. It's either too hot or too cold in China, depending on who's hitting the brakes and who's hitting the accelerators. The inherent problem that China has is, though, it has two governments, and we've talked about this. You have the central government that is trying to slow things down, is worried about social unrest, is worried about social cohesion and income inequality. They're hitting the brakes, but the local governments who are in bed with the developers have every incentive to keep developing, keep building. And so while one government is hitting the brakes, the other one's hitting the accelerator.
Hey, Jim, okay, let me ask you this. You've seen a 27% decline in the MSCI China Financials Index over the past year. Is that enough for you to take profit at this point, or you're keeping your shorts on?
Well, you know, we were short the home builders and the credit-related stocks in the West in 05, 06, 07. And all the way down, there were 30 and 40% rallies from new lows. And yet things kept deteriorating. And basically, we covered our shorts in 08 when things basically stopped deteriorating and when the government actually did step up with real cash. We're not anywhere close to that in China. This has just started. As I indicated, the property slowdown started in the third quarter of this year. So the stocks are going to, look, China's a volatile place, and the stocks are going to go up and down like yo-yos. But we're keeping an eye on the fundamentals, and the fundamentals have just started to deteriorate.
Hey, Jim, on the strip across the Asia Pacific, I know you stopped off in Australia. You're here in Hong Kong for a day. Now you're in Singapore and on your way to Tokyo. Why didn't you want to stop off in China, dip your toes in a country that you've been attacked for not really knowing? I mean, Jim Rogers said back in 2009 you didn't even know how to spell China.
I know, and he lives in Singapore. Look, no number of visas in your passport or length of residency will replicate or substitute for a lack of judgment. And I know plenty of people who lived in Miami their whole lives who lost everything when the real estate bubble burst there. We have analysts who go to China all the time, Susan. So I was happy to be in Hong Kong, as you know. It was great to see you and others there. But a trip to Shanghai and Beijing is probably some ways away.
All right, Jim. Well, enjoy the rest of your trip across the region. Thank you so much for making time for us. I know you're a busy man. It's good to see you. Jim Chanos of Kynikos Associates joining us from Singapore.